Sean mentioned, um, I'm very grateful to have such a wonderful group together with us. So it's my pleasure to be able to do this every weekend, and I kind of look forward to it. It's almost like a family now, and I was up till 2 last night, 2 in the morning. My son just became teenager, so it was a really interesting time, and really enjoyed it. But I get really excited to come on Saturdays and meet with you. I really appreciate again our friends across Atlantic, up 10 o'clock at night in London or Manchester, and joining us. So I really appreciate that. I also want to welcome one of my good friends. We've known each other for many years, and he contacted me last week and asking me how's everything going. And I said, I'm doing this. And Jean-Claude, I'm so happy you have joined us. He's one of the brightest minds that I know. With his background is in structured finance, and in Europe, he's worked with some of the top banks in from Germany to all over Europe, and his background is in international finance and again securitization. Getting his MBA from London School of Business, and and also Martin. He graduated from the University of Maryland with his international finance and business major. So, Jean-Claude, again, I'm so happy you're with us, and we will enjoy your thoughts. Maybe in the future, maybe you can be a guest speaker for us. So,
Thank
thank
you,
you.
Ramin.
Thank you. That is awesome. So, as Sean mentioned, these are really exciting times. We are the times that I don't think I have seen it. These are the times that can make multi-billionaires, and the yachts that we were talking about 2 weeks ago from Florida, people in matter of months can pay for all those. And unfortunately, some people who have had biases and trying to make their own ideas to make sure markets follow theirs. So based on that, this is what I like to start with is Choshin is a word from Zen Buddhism, meaning initial mind, beginner's mind, and it refers to having an attitude of openness and eagerness and lack of perceptions when studying a subject, even when studying at an advanced level, just as the beginners would. And I think this applies in life generally. It happens even with our relationship with our children, especially if you have a teenagers like I do, in relationships, from business partnership, but more so in the world that we are living right now, and especially with these markets. And from the beginning, what I have emphasized is there are so many things that we have in our background. We have our own mindset that sometimes I think we try to dictate those biases to the markets. And that's why, like a lot of economists, they don't really agree on a lot of things. And I don't know many really wealthy economists. I mean, they're brilliant. They like to, they have bright minds, but unfortunately, because of the biases and their mindset, they're not very successful in investing and trading. And so for me, again, what happened, let's say on Friday, and what has been happening, this is a good indication how you really have to be open. Every morning you get up, you just look and see and follow that rather than having this preconceived notion that you know better than the markets. Price is the king, market knows best. You can be prepared, and that's what I'm hoping in next hour, an hour and a half, that every week that we're doing, I hoping to give you a small amount of tools to give you that preparation. On the other hand, at the end of the day, we want to make sure we are profitable and while we are enjoying this process and the journey in learning. So with that in mind, I think that help us to understand the markets better, and we don't have to watch the CNBC and Bloomberg and they're having their or the Fox and CNN telling us what we should think about. So this week, let me start with the markets first and see what happened. Again, Friday was a very interesting day. Basically, if you recall, it's every first Friday of the month is the employment or unemployment numbers come out. And almost 75, almost every economist was thinking that we're going to have a loss of 8.3 million of jobs. And instead, we had creation of 2.5 million. And what happened was there's a huge discrepancy, and we don't know whether this is the way the way that the Bureau of Labor Statistics does the things was a glitch. What happened? How could you go from almost the worst month of unemployment to go, the 2.5 million was the best ever? I mean, this is a huge gap. So there's a couple of things, and this goes back to May 13th. So these numbers are from mid-April to mid-May, and there's just few ideas that as you know, April unemployment was like about 14.3%. We had 19.7 million jobs lost, and the question is, how they come up with these numbers is the Bureau of Labor Statistics. They actually call people and they say, are you employed? What are you doing? So when you had, in the March and April, well, a lot of small business, especially a lot of companies, they didn't know what they're going to do, especially with this PPP and, all the assistance that the government was giving them. So basically, a lot of people said, well, we don't have a job. And then they find out, well, no, they will be going back to work. So they were collecting unemployment. It's still, to this date, a lot of these smaller businesses, especially, they do not know how they're going to plan a prepaying. They only got 8 weeks. Most likely it might be extended. If they don't use this, if they don't use 75% of the loans that they got, then they have to pay interest or they have to pay it back. So 75% goes to the payroll, and if they don't use it, and a lot of employees, they're making more money from their unemployment check than they were getting from their employer. So a lot of them are saying, well, we're gonna stay on unemployment as long as we can. So there's this dilemma. So it goes back to again, there's interviews. So there is that kind of discrepancy, what happens. Hopefully this is real, but it is something that is fluid. But the way the markets are looking at, as far as these, as far as the stock markets, what they're looking at is, they're saying if there's good, these numbers are good, then that's good, because markets are a discounting mechanism. So they're thinking 6 months, everything will be good. And so it is justified that S&P or NASDAQ has passed its all-time high, and S&P has like very close to that. So that's one part of the equation. The second part is they say, well, if the markets, if the economy is not doing that well, then we got the Fed. Fed is the one who's going to save us. And I had mentioned it before, again, these are the times that is unprecedented. I mean, we had it in the 2008, 2009 financial crisis. We've gone way beyond what the Fed did. They were very proactive this time, but when they actually are purchasing our debt, they're buying ETFs through BlackRock, for instance, and PIMCO, then there's something is not organic. I've said it before. But again, if you're an investor or trader, you're trading the markets. You're not trading logic. You're not getting a A or B or a trophy for your guesses. The markets are always right. So this is what the markets are doing. So I thought this is from the Barron's, and this was a week that we had. And as you can see, it was fantastic. Dow Jones is at a 6.81% return for the week. For the 52 weeks is actually up 4.34, and for the year to date, we're only down 5%. S&P had another nice week, and you can see NASDAQ, who has been the leader, they were only up 3.42, and the small caps were the big winners. Basically, I've said it before in the last few weeks, you can see there's the sector rotation coming, the movement out of the technology, moving to more of economic sensitive stocks, and basically some of those beaten up from leisure to hotels and airlines and energy. So that's where the money is rotating. The interesting thing is this was the fastest movement of that. That's why it now looks like a V bottom, but definitely economy is not a V bottom, but the stock market looks like it. That's the fastest in 75 years that we've had a movement of 30% in about 50 trading days. This tells you where majority of the changes came from. I look at the sectors, but also I'm looking at what is happening, the difference between like small cap. You can see S&P small cap was 11.98% up compared to NASDAQ, which was 3.42, and Russell 2000 was 8.11. And there's a strong advanced decline line for the last week. It was 2,669 advancing issues. That means that the stocks that they went up on Friday compared to the declines of only 376. So this has a leg. And new highs, 52 weeks are there, 143. Last week there were 82. We also look at the dollar. We will look at in charts to see what happened to dollar, bonds, the crude oil, and where is gold right now. That in mind, every week I like to look at the economic background and see what is the activities, economic activities. This is from the First Trust Advisors and Department of Labor. They come up with the numbers, and we look at the initial jobless claim. It still, these are huge numbers. When you look at what it was a year ago, it's just going the right direction. As you can see, for the week over week, we are improving. And the jobless claims, I mean, we have 21.5 million. But the thing is, it is compared to a month ago, it's in a little decline, but it's accumulating. Still not by any means, these are horrible numbers. And the retail, and this is interesting, we look at the box office receipts. My son yesterday, you know, he wanted to watch a movie. Obviously, he couldn't go to the movie theater, so we had on demand. Him and his friends, they stayed home because there is, I don't know how long it's going to take to go back to the movie theaters, but this is unbelievable, having only 335,000 just because of the situation compared to 283 million a year ago. And again, basically, this is just interesting to see, is there real improvement? Is that when the hotels are opening, are the people are open to use them? And how about the TSA, the airlines? And as you can see, the hotel occupancy is the right direction. Again, the daily rate has been going up compared to 4 weeks ago and last week. And the revenue per room is going up. So basically, this is more of the meat of the things, but it's the direction right now, and people are being very positive. Now, going back, this is, I did this chart about 2 weeks ago, May 13th or so, and I mentioned that what is happening at that time, I did not have a bias. As you could see, the first 15 days, we had a large movement. All the movement came in, but the previous 4 or 5 weeks, we were in a box. What that means is we were pretty contained. So the energy was contained. This was, I mentioned it is coiling. They are just they don't know which way they're gonna go. I didn't know which way it's gonna go. All I knew, if it's gonna make a move, there's just so much energy that it's gonna go, either way, it's gonna be a huge move. And we were right at the mid-range at 2863. This is for the SPX. And this is what happened last week. As you could see, this was our box, and then boom. I mean, we made this whole length of the width of this box in almost 5 or 8 sessions. And we didn't even hesitate at the 200-day moving average, which is also a round number. 3,000 round numbers are usually pretty big support or resistance. And you could see the volume came back, even though still we had some volume after hours and overseas. The Globex was doing a lot of activity. A lot of times it did go up, but we did have, again, the buyers are there. You cannot question. I mean, there's no, as many reasons as we have to be negative about the markets. This is what it tells us, that there is a fuel and there's optimism, whatever reason this is PE wise, earning wise, we are in a very expensive market, but you just have to trade what the reality is at this time, which is the price. So this was the energy we were talking about. I did the same thing with the bonds. The bonds were also contained for many weeks. This is from 2 weeks ago, and you could see that the energy again is back and forth in a narrow range, and something is really happening. And this is what happened last week. So basically, the bonds dropped, which meant, number one, the risk was off. That means the risky assets will go up, and the defensive assets and risk-on assets like bonds, and we will talk about, let's say, Japanese yen, gold, the dollar you're looking at, they all they lost their as far as accumulation, and this is how the breakdown happens. And that was a big movement in bond market. We will talk a lot more about bond. This is an ETF of a 20-year bonds. And then I'm looking at, this was huge move. This is the 10-year yield. So we went from 0.678% in 3 days. We are at 9.04%. And we will discuss more about what are the consequences of this big movement, because this is huge. So basically what that means is, now that the yield is up, the money is gonna leave the bond market and move to the stock market, or is it? So that's what we have to discuss. What happens, and I've mentioned before, Excel, the financials are the key for the real movement in the S&P. If S&P is gonna have legs to go up, it definitely needs the banking system behind it. Now, with the movement of the bonds, what happened was, because the yields were going up, it's very positive for the financials. So that's why we had these big moves from Goldman Sachs to Bank of America to Wells Fargo. The index went pretty nicely up. Now we are against our 200-day moving average. So next week is pretty crucial. Let's see if it holds. And again, this is more of a bond market play. Let's see what happens with the bonds next week. And the reason I talk about next week, why we need to be wary of that, because on Wednesday, Fed Chairman Powell is gonna, they do have actually no conversation or private time till Wednesday. They cannot interview with anyone to come out, and then they're gonna make up their minds. They're gonna come out and talk about the interest rates and their future direction. And the question is, if the economy is picking up and if the economy is doing good, are they going to be still accommodating, or are they going to taper down? And is this is a crucial time. So we'll see what happens, because I believe we are in euphoria right now. It's, for me, just as an observer, it's difficult to see that we are back where we were, let's say, in December. And just from the price earning ratio, I'm looking at the earning growth of the companies, which a lot of them have decided not to announce them. Are we in the exact same economy when there was a 3.3% employment? And what is real? All I know is we had that, again, exogenous effect of a health problem, which affected, really froze the world. And now what is happening, the world is feeling optimistic. And one of the reasons that the global, or not only because the central banks are all working together from Europe with their, unbelievable $750 billion stimulus package. And who would have thought Germany, which is always the last as far as even initiating anything as far as austerity goes, they approve $130 billion package. Now, it was about 30%. Everybody was expecting if they did anything, it would be 100 billion. They came with $130 billion. So there is this cohesive partnership with all the central banks. They are going to do this at any cost. And because of that, what has happened, the dollar has dropped. This was, again, a box. If you look at this, we were, again, coiling the energy, and then this is what happened last week. Now, because of this drop in dollar, obviously it's helping the global markets, especially emerging markets. So basically, that's also putting the fuel on the growth of international markets. So that's what the equities are, basically were the winner last week. And I wanted to show you, this is where we are on a weekly basis. We are sitting at the 200-week moving average. We'll see if the dollar is going to hold. Right now, there's a heavy pressure on it. It might break down. So basically with that, I think it was 2 or 3 weeks ago, we talked about Bitcoin and alternative investments. And because of that, you can see how Euro has nicely moved up. We will get that. Now, going back to the Fed, every week I like to review there are 3 main ETFs, which there are. The number one is the LQD. And this is the one that we go back to on Thursday, never forget it, when the Fed came and so the $2.6 trillion package in the morning, using the Treasury Department to use BlackRock to start purchasing exchange traded funds, which is really helping the investment grade corporate bonds, which are the BBB and higher. This was a very important move, because if any of these BBB companies would have been downgraded, the whole funds, everything would have been restructured. There would have been big sales, liquidation, because let's say LQD cannot hold, it's like a double B or B or C. So basically what happened was, in this case, the Treasury really, the Fed really saved the whole high yield corporate bonds by doing this action. Now, one of the interesting things about LQD, and again, I'm sometimes repetitive because I want to do this on your own. I want to be aware, let's say on Saturday while you're reviewing things, you want to see what is happening, what are the activities. Look at the volume here. But the interesting thing is LQD has been actually leading the markets. So we actually, as you know, the March 23rd was when we had that capitulation, and that's when the markets really dropped, and then we started moving up. But LQD had its own 2 days before that. So I'm watching to see if we are topping. Now, one of the things would be, as I mentioned, is there going to be any tapering off on repurchasing this? The volume was very heavy, but when I look at the bond market, the volume had really dried out. The reason was because the Fed was the one who was buying the the bonds, and there was really no open market. So really, as I mentioned, this is not organic. This is not real open capitalism. So the capital markets had nothing to do with that. So they basically, one of the reasons the bond market dropped, because the Fed apparently has slowed down in their repurchasing. And this happened in Japan, for instance, many years ago when they started their program, because they've been buying the bonds for many years and nothing really has happened. As you know, they're still in a kind of deflationary economy. And what happened, there were times that when the government stopped, there was one year, God, I don't know how many years, a few years ago, the volume on the whole Japanese bond market open market was one. There was one contract was traded, and the next day was zero. So we'll see what happens with this. But right now, this is how the Fed is influencing the markets. And again, this was not like a stock market crisis. It's really basically it's been a credit crisis, and the liquidity was the most important thing. And that's what this JONG, the high yield bond funds, again, as you could see, that we had this big move. There was a big announcement. We came and we stabilized around 96, and then now we are going back to almost where we were in before March. So I think this is important to study to see if there's going to be any divergence or there's going to be any changes. The other thing I look at it from the stock market point of view, I want to see how many of the stocks are above their 200-day moving average, which is important because that's what the funds, institutions watch. And in the extremes are like, let's say when we had it was everything was being sold. I was 95 to 97% of all the stocks were sold. The other thing is like there was divergence between this and the S&P and NASDAQ because we have talked about the top 5 and 6 companies representing in NASDAQ situation is like 52% of the whole index in NASDAQ 100, which is, you know, it is Apple and Amazon and Facebook and Google and Netflix and Microsoft. So they, in reality, that was not a real picture of the markets. And that's why we look at the 200-day moving average, the percentage of the stocks, and you can see we have, since May, we've had the legs. So the money is going back to those stocks. So it shows, that's another thing about the rotation. You can see we just broke above 200-day. But again, this is where we were in January. We were in 80, 85, and we are right around 60. But we are almost, number-wise, we are there. The other thing is about gold. So you can see with the gold, the markets actually gold went down, and the main reason is, again, not a collapse, but again, what happened was a big time, the increase in rates, and which is not good for gold. Although the dollar was down, and we correspond to the lower dollar with a higher gold price or commodity price, because of interest rates play a big role in gold pricing because of the storage costs and other things, and also alternatives. Because of that, gold usually goes down. But as of last week, notice again this box, we still contained in this box. So next week we'll see. If we break down, then most likely we will continue. But the gold is fighting this, and they know something. So we'll see what happens. Again, next week is important. Again, depends on the announcement on Wednesday. I'm going to divert from the charts as far as where the markets were and why we're up, and there's a lot of things to be positive from the charts point of view. But one of the important things is the sentiment, because people buy and sell based on emotions, and we call it fear and greed, or euphoria and exhaustion. So I follow something called put-call ratio, which is compares what the institution, the number of contracts on equity indexes, the number of puts compared to calls. So when you're really negative about the market and you want to buy as many puts because you feel the direction is going to be going down, so you want to protect yourself. Now, this is not 100% because a lot of institutions who are long, they also want to protect themselves by hedging, but it is a pretty good indicator in the past. It's not right on the bottom, but it just gives me some type of a sentiment of uh, as far as speculators, but also institutional investors. As you can see in March, there was just so much fear that we had almost 1.5 put options compared to one call. And that's, believe it or not, that was the turning point. I also use a 10-day moving average to smooth the movement. And what I like to see, I look at things about 1. So when it's under the 1, then that means there is, I mean, when it's over 1, there is a healthy fear, and that's the markets will continue going up. But when this goes below 1, and especially continues, I have a criteria of 0.75, then that means there is some type of a complacency. I mean, this is what happened on Friday. This is one of the lowest we've been since December. So this is just a heads up. Again, watching the put call, you can go to the CME group or even CBOT, you can see the numbers. This is from the trade station, but you also in stock charts, you can see the put call ratio. That's a free service. But I put this is a 0.65, 63. I want to look at the low where we were, and we just broke through that. So basically 75 and under tells us at least heads up. So these are the sentiment. Next few charts, I'm going to talk about the sentiments. Citigroup does their own market sentiment. So when there's a lot of fear, there's panic, and it goes back again in March. But what happened, we were actually about negative 35 to 40, and that's what the reaction was. We've got to be out of the markets completely and look at what happened later. As you know, the markets have been just moving up. Now, this is where we are. We are in the euphoria zone. So this is the time to just be wary. That doesn't mean things are going to drop next week or next 2 weeks or 3 weeks, but it does. It just have the heads up. I had mentioned again before, you want to trade what you see. Do not fight the Fed. The liquidity is the king. But be cautious, be nimble. Make sure you have your stop losses there. Make sure you know that are you going to be a trader or investor? If you're an investor, then these noises should not bother you. You're going to hold on for 3, 5, 10 years, then just be it. But don't be a trader and say, well, I'm going to hold this for 2 days or 5 days. I use this strategy, and I put the stop loss, but I'm going to negotiate. And when the things go against you, let's say you're losing 10, 15%, all of a sudden, oh, you know what? I'm an investor. I'm going to hold on. I know it's going to come back. As I said it before also, when you find religion in trading, that's the time to get out. When you start praying, that's the time to get out. So make sure that you're prepared. As you can see, there is some euphoria. The same thing in the CNN has a fear and greed index. And that's interesting because you can see there's been, they're not precise. They use different factors, including that put call ratio and the VIX, the volatility. But right now, last week was at 62. And guess what? The markets had a great week. Now we're at 66. Again, these are the things that you want to just watch. Just have a little, just on the side note, that you want to be a little cautious too while you're long. Just have a little hedge. The other thing is, McClellan summation index, we were very oversold, as you can see, and usually about 1,000. You want to be, you're getting close to that. And the same thing with the oscillator, the McClellan, that again, it works more better on an oversold condition, but I've noticed, than overbought. But again, we're still getting anything over 100. You just want to be cautious. And also, there's investor sentiment group that they follow the momentum indicators, and they look at what is happening as far as these momentum indicators are very short term. So this is, they are at the extreme as far as the optimism goes with the momentum. So that's one. The breadth indicator, it was at 95.84. That means out of 100, 95.84 were up, and their direction is up. And we are at, actually it's 95.8 actually, but the breadth was pretty up too. So basically, this is a word of caution. In the meantime, VIX, which is a volatility index, it sometimes is called fear gauge or fear index, is, you can see we hit the highest since, I think we had seen it once in October of 2008, and that was one of the highest. So it's been going down, but usually under 15 is normal. We're still above that. We are in the crucial 200-day moving average. So it was down by 5%, but it should have been a lot worse than that. So toward the end of the day, it actually came back up. So we'll see. Again, these are food for thought. You want to follow those. And then I want to see what happened with the small stocks, like, which is the IWM ETF. You can see, again, because of the rotation to the economic sensitive, energy and financials are the biggest components of the IWM. I had mentioned before, if you want to see confirmation of the markets, this is where you want to see. And apparently we see that we just broke above the 200-day moving average. It's only one. Institutions like to have two confirmations. That means they want to have 2 days in a row. So if it stays above, then it will continue. We are close in the Fibonacci's. Once you pass the 61.8 and you get close to the 78.2 area, then this bottom is out of question. Basically, we're just so far away. I mean, I know I've mentioned before, again, NASDAQ is not coming down to this. If there was any, it would have been IWM, and then the transportation, which is this one, we broke above that as well. It's a good volume. There were a lot of airline stocks. I'm looking at the trucking and the trains, railroads. So that was one of the reasons. But one of the interesting things are that, again, the moving averages, it was just so far, there's a big gap. Moving averages don't like to be so far away. They like to be close to each other. So when there's that, the prices like to bring them back together. And with that in mind, as I mentioned, the emerging markets had a very nice week as well, because again, the weakness in the dollar, which affects them, but also it allows the flow of the funds to those emerging countries. A couple of weeks ago, we talked about airlines, and I mentioned it would be a good time maybe working with the more solid, with less debt companies. We talked about Ryanair, and you want to stay away when they were like two international companies from Colombia and Chile when they filed for bankruptcy. Well, you want to concentrate more of in the domestic airlines, and look what has happened in the last 2 weeks. Alaska Airline was around $30, and we closed at about $42.72. So it's been a nice run from America Airlines to United Airlines, and a lot of airlines, just because of, again, that hope, and also knowing that the things are, we're in the phase 2. So these are the things you want to watch, because they're an indication of the attitude and toward the economy. Last but not least, I just want to show you again with the stimulus package in Europe. Look at what happened with Europe. I mean, euro was very close to go to parity with dollar on March 23rd, and look, we are at 113. We are kind of overshot it right now. So let's see. In the long run, probably it's going to go down, but we need a little digestion. So we need to come back and kind of digest the situation. But right now, the way the dollar is, its euro, and with all the stimulus packages going on, euro is finding its footing. All right. As far as the markets go, again, next week is important. I thought share with you. Every week I try to do this to a couple of trades that I had. I had a few trades. It was a pretty active week for me. It was pretty profitable, and it was with the options market, it was really fun actually. So I did a few option trades, and I thought I'll share those, a couple of them with you. One of them was, I noticed there's, this is Sasol, it's a South African oil and energy company, and it was a double whammy. They were beaten up, first of all, being emerging country, being from South Africa, and then also being in energy sector in oil. So they were really beaten up. So I've been watching that. And then we had spoken about, this is the 20-day moving average. And as you could see, the price, again, the strategy that we used a few weeks ago, look at the gap and the space between this price and its 20-day moving average. Now, if you recall, the confirmation is when the color of the candle changes, which it's confirmed, and it closes above the high of that candle. So when this happened, then that was at least a short-term confirmation that it's time to maybe start moving. But on the other hand, there was just a lot of fear, so maybe you missed that. And then we noticed that this 20-day, you can see it came and got to that 20-day moving average, got away from that, and again it came back. Normally what happens with moving averages, when there's a short term, once the prices move, they go beyond the first moving average, they like to go to the second and eventually go to the third or fourth. So if you use 8-day moving average, 8 goes from 8 usually goes to 20 or 21, from 21 goes to 50, from 50 goes to 100 or 65, and then from that it goes to 200 eventually. So I've been watching this, and then we had this cross over this again, that now the 20-day is above 50 days, so that's a strength. But then I had a gap up, even though it's a ADR and I don't like to play that. Last week I noticed there's a strength at 579, it just moved up to this. So that was on my radar, and I decided, this could be a good short term. It looks like the strength is back. Look at this volume, there's a lot of volume. We are in a past, so 50 and 50 usually, I mean, in stochastics and in RSI, as long as the stock is above the 50, that means it's in the buy zone. When it passes the 70, that becomes overbought, and 80 means it's still strong enough. So that doesn't mean it's overbought completely, so that you have to sell it. That means there's still enough strength. The time that you sell it, when it actually turns around and goes below 70. So for now, you can see once we cross at 70, we continued. So I decided right around here to buy 2 types of options. Now in options trading, and I'll explain that hopefully in next classes, you can actually diversify in many ways. So you don't have to just buy an option in one price. You can diversify buying options, let's say options price of 5. So you can diversify based on the price, your strike price. So let's say 5, 7.5, 10. You can also diversify with the time, because remember, these options that have their own time expiration. So if you have June, maybe you can diversify to July. You can also use different volatility sections. So, but the main ones are the price, a strike price, and also the calendar date. So what I decided to do in this situation, I will show you, because I had another one. Again, this one was in leisure, and this is Norwegian. I could see what was happening with the airlines. Again, we crossed the 20-day, it has been on my radar, and right around here I decided this was a you got to be lucky sometimes in life. So I decided we broke above the high of that candle. At this day, I decided to buy options on Norwegian Airlines, which was, I mean, Norwegian Cruise Lines, which was actually, this was Thursday, and this is what happened. So this is from my, the same thing, this is from my trade station. I'm using, in this situation, I use a 3-day, 8-day, and 20-day moving averages, and they are exponential, by the way. So as long as the stock is above 8-day, which is that purple line, that means we are in an uptrend. As long as stochastics is over 80, that means we're in uptrend. So that was a good call. The odds were in my favor. I had a big support here. So that's why I had the confirmation to go and do the options. So this is on SSL. So I bought a July 17th call at 5. So they were in the money. And this is where I bought them. And they were around $2.16. And then I had 5 contracts, and I just got out of 4 of them. And as I have mentioned before, I immediately have my targets. I know where I want to get out. And again, I will show you how you can sometimes be really lucky. So, but I do put them in because who knows what will happen. I might be busy, or so. Again, the markets were very kind to all of us. So with the, especially with economic sensitive stocks, with the, and then here, the Norwegian, I sold, I think one was about 200% and 100%, or, it was pretty good trade. And the other one was, I did, oh, this is sorry, Norwegian, I did the 2 different. So I bought it on Thursday, and I had put my limit. So basically, I had bought it about $1.45. I had 5 of them. I like to make increments of 25, 50, and 100. So what happened was I did put those limits. And again, this is where you get lucky. Norwegian gapped up the next day. I mean, it was sold at $4.95. So it went from, this is in one day, less than a few hours actually. It went from, I think it was about 150, 145 to $4.95. And it filled. And I didn't even know. I had a long night. I got up and I see, oh my God, it's already filled. So that was my June. And the same thing happened for my July. So basically, I thought that's good. You want to make sure you put your targets in as soon as you put your trades. Also your conditional, if there's a collapse. Usually I know, because I'm buying calls, I do have a 50% loss because I know my risk is very much known because it's the premium that I pay. And I'm not in a option trade to make 5-10%. I'm usually get in because I want to make average of 50 to 100%. So if I lose, I don't want to lose 10, 20. I know my risk, so I'm willing to lose up to 50%. So if it is, so be it. If not, then I stick with it. So that's my trading with the options. Okay. Today I thought with the way the markets are, and this is my outlook for next 10 years. As you know, the 2010s, basically after the financial crisis, what happened, USA was really the best performing majority of times in the developed and emerging and developing markets. There was a lot of money coming to the United States. We had the fastest economy growing, while the Europe still had many challenges. Some of those, even UK, never really hardly went back after many, many years. Finally went to break even where it was in 2007. China, the same thing. A lot of emerging markets had really broken down in some ways, and that it took them a long time to just even go to break point or break even point. So we have these cycles. So 2010 to 2020 belonged to USA. Now the 2000 era with the 3 down years from 2001 to 2003, what happened was this was a commodities cycles. So I believe with the although dollar is still going to be strong, I think the reversion to mean will work out. So if I'm being selective now, if you ask me for next 10 years where I would invest for a long term, I would be more positive on number one. If it's USA is the technology, I still feel we are the leaders in that. But as far as a whole, I think emerging markets present fantastic opportunities. And these are my reasons. Before I go to that, we live in such a wonderful times that you as just individual investors, you have such a great access to so many variety of investment opportunities. In 2018 Russian World Cup, I developed my own World Cup uh, international fund. So out of the 32 countries who participated in the World Cup, 22 of them, they had their individual country ETFs. So I was following that, and I wanted to, this is for now, but I should go back and search how they did while the World Cup was going on. In 1990s, when I did my thesis for one of my degrees on the relationships between the World Cup winnings and especially the championship and also being a host and that region's stock market. Basically, I tried to go back to from the beginning and separated the developed countries from developing countries. And I want to see if the euphoria plays any role. For instance, let's say if the Brazil becomes the world champion, would the stock market go up rapidly? Unfortunately, well, I can tell you after all the studies, all the paper, there was no relationship. The same thing happens with Olympics. The markets do go up till like a couple of months before when the Olympics happen, especially again in countries like, let's say Greece or let's say South Korea and emerging countries because of all the funding and construction and development. But after that, you go back, it's very sad to see what has happened in China after Olympics, what has happened in Greece, what happened in Brazil, with billions and billions is spent on the infrastructure and the stadiums and other things, they are ghost towns. And so basically that's one thing. But as the other thing about with the World Cup was a lot of these emerging countries, they did not have really developed stock market or the participant, the majority were institutions. It's not like United States, which average investor has access. Those countries do not have the participation of their individuals. So the euphoria would be basically emotional, and there was no really relationship. Now the things have kind of changed because of more people have access, and I will explain why I'm positive in emerging markets in the long run, because individuals are growing the middle class and the access of the pensions and other things, the development has become more correlated. And what that means is, after my study, Goldman Sachs did a study in 2014 World Cup in Brazil, and they found out, yes, there is a direct relationships between that country being the host and also winning, and it is for 2 months. So that means right when the World Cup starts, the markets start going up, and it goes up about 2 months, and after that, it fizzles. So that's the thing. So I decided again to do that. There were 22 countries from Argentina to Denmark, Egypt, this is Poland, Peru, we have Australia, we have Sweden, Germany, and so on, Japan. So, and as Russia, Portugal, and Nigeria. So we are, again, very blessed that we have access to so many opportunities around the world. Believe it or not, there's about 67 individual country funds out there. So you could actually have your own diversified international or regional or any type of a fund that you want, and having the no commissions and no administration fees, you can start with a very small amount, and there's no education better than actually investing in something that you enjoy and learning about it. So I could have had $2,200, put $100 on each one of these, and see what happened. So why emerging markets? The number one is the potential for high growth. Because when you look back, if you think about 1950s in the United States, we came from after the World War II. We had the, the, the baby boomers coming back. They built, having families. We eventually moved to having more middle class, that they want to own a car, they wanted to own TVs. We went to 2 cars. We ended up having washing machines. And so just visualize that and think about some of the countries now, and some of them are frontier countries, which are the developing emerging countries. They are in those days. And add to that the technology that they have access to, and imagine what happens. And the same thing is happening now. So you can see the potential is unbelievable. And I give you some of the reasons, which will be the demographics, and we will get more into that. The second part is the diversification. So the factors that involve with investing in those countries are completely different than, let's say, in USA or some of the developed countries. So there's a lower correlations. With the globalization, as you can see, there is more correlation now than ever before, but still they allow you to have some type of a diversification, in the sense that if the markets are, let's say, going down with the movement of the funds, you could see that the money could go move there. If there is a potential there, you could have access to that capital. And that's why the diversification becomes more important. Unfortunately, when there's disasters, and that's one problem with diversification, which is supposed to be, that's the reason you want to be diversified, is in a major global exogenous and major crises, diversification obviously doesn't work as much, because everything goes down. And the whole world went down in 2008, 2009. Everything was down. I think there were 2 or 3 asset classes. Bonds were up a little bit, gold was up, lead was up, and palm oil was up. So every other asset was completely devastated. So, but we are talking about not just in the complete crisis, but when the markets are down in one country, you want to, by using some other countries that they're independent of each other. And I use one example. For instance, if you have like India, which is more of a commodity as far as like, let's say, oil import country, and compare it to let's say Canada, which is more of an exporter, Mexico. But just having that, when the oil goes up, obviously Mexico's economy gets better, or Canada. But India, it's more obviously cost. But on the other hand, when the oil has been down, then that helps that economy. Just a simple example. So that's one of the other reasons. But the other thing why you want to do internationally, because with international, you're not just looking at the stock market return. It's not like United States that if the S&P goes up 15%, you want 15%. You also have a potential from the currency return. So if the dollar is weaker against, let's say, euro or Canadian dollar or Aussie dollar, then basically you can make money in 2 ways. The opposite is correct as well, because if the currency goes down and on top of that the market goes down, then you lose in both ways. So this is a diversification comes from the currency point of view. So you could have double whammy, or it also could be if you have a currency, if the market is down but your currency is up, you reduce your risk in a way. So I just use an example. Let's say euro is up 8% against the US dollar, and also the euro stock market, whatever country you're using, was up 10%. in reality, instead of making 10%, you made 18.8% on your money. And that's why it's interesting when, let's say, British pound went down to like 114. What if I went to UK in London, or I invested money in FTSE, I exchanged my money to, let's say, 115, whatever it was, and today is like at 126, 125. I can exchange it back. I make money based on that, plus the return on my stocks. So that's another reason for diversification. Also, these emerging markets have very unique characteristics. One of the most important and the least talked about, and I emphasize that a lot, is the social and cultural aspect of these economies. The things that we take for granted, things that we feel it's given, let's say, in Western world, is completely different in developing countries. One of them, I would say, that I will use couple from the social point of view, is there is a close blanket of support, the social net. So if I lose a job here, obviously I depend on the government. We do have a very big in a large country. The family social net is not as strong, and then let's say some of those countries. I'm pretty familiar, let's say, with the Turkish culture, for instance. Now, if usually there's always one or two people who are out of jobs in the family, and I'm talking about extended family. If there's cousins, there's a nephew, well, what they always have a place to live, and they always being fed most of the time. So there are not that social net is there. The cultural, I would use, let's say, bakshish, for instance, in India or Egypt, some type of a bribery or a black market, and they are very much accepted. Then that's understanding that is also important, how that works. Demographic is my biggest reason for investing in emerging countries, because what happens with the Western world is developed countries are very much aging countries, including especially Japan, for instance, or Germany, and the United States is getting there. We are living a longer life, but also our fertility rate kept going down. So in reality, you have this large growing population from the aging population, but not enough support from the younger population to help them to, as far as the social, but also financial health. But demographics there, we have a very young population in many countries, especially in Africa. And I used, let's say, I've been very positive on Vietnam for many years. Like in Vietnam, average median age is about 24, 25, but they're like 16, 17-year-olds. That's a working population. And that's very important. And what happens because of that, there's classes that have been very much separated. We talk about India. India, one of the things in the 90s happened, they started the movement to the middle class. And middle class is really the heart of any economic development. They are the ones who have the dreams. They want to have education for their children. They're the ones who want to drive their own car, own their house. They want to have TVs. They want to have their toys. And that's the one. The consumerism doesn't come from the ultra wealthy, and obviously doesn't come from very poor. It comes from the middle class. And Brazil went through that, but unfortunately from the political reasons, things have been going up and down. India has gone through that. It has doubled its middle class. So middle class is a very important characteristic of these emerging countries. Technology has been a fantastic reason to be hopeful about these countries, is because there is no discrimination. I mean, you go, I know it was a country, I mean, in India, I know I've seen in Turkey, people who are live in poverty, they come asking for your money, and then their cell phone rings and they pick up the cell phone and talking to their friends. So everybody has access to, let's say, phones, and the internet is becoming more and more available. So basically we are living in a very smaller world. And I remember, I use this example a lot, in 1993, I remember in Malaysia, uh, all the roofs had uh, dishes. You know, they were watching American and German movies, and they see beautiful women, and then the men, the doctors they own in America, in California, there are two cars, and they have the children have their TV in their own room. So they would wake up and say, why not us? So that's the dream is the biggest motivator. Nothing else. I mean, all the speeches in the world doesn't help to be motivated. It becomes, when you watch something and you believe within, that motivation actually becomes inspiration. And that's what has happened. If you compare Kuala Lumpur right now, if you go to Seoul in South Korea, I mean, there is no comparison. These are like, you think you're in New York City or, you know, Chicago, and that's what has happened. This all started with a dream. Um, a lot of these countries are also very much natural resource dependent. So what happens is that prices of raw material still is a big factor in their exports. So that's another thing. And the labor, as you know, we are moving a lot away from the labor incentive to more of intellectual and service oriented. But even today, you can see we still need material. We're talking about trade we call trade war, but whatever trade competition with China and United States talks. Well, countries like Philippines or especially Vietnam and let's say Honduras taking over Mexico, and let's say Vietnam is becoming China's China. A lot of things are moving to, factories are moving to Vietnam to have a low cost labor. People are willing to work long hours. So that's also a very unique reason. I put business laws because there are a lot of entrepreneur minds in those countries. You can talk to an 8-year-old, has this big plans. The problem is it's a challenge because the government can decide anything. Brazil used to be one of the longest. If you're an entrepreneur, you want to establish your business, it might take 350 days. In the United States, it takes 7, 8 days, 4 days. So those are the challenges. So the business laws have to be changed as far as if they want to have better growth, and they're working on it. One of the things I remember in the 90s, for instance, investing in that used to be Bombay, now it's like a Mumbai, you know, the stock market would be open 2 hours a day, 3 days a week. So I would, you know, if I want to put a trade in, it will take, for 2 hours I could trade, and it will take 8 hours just for the paperwork to go through. Now things have been very much automated. It's been fantastic. I remember I visited, you know, Buenos Aires Stock Exchange. So they had the old building. It was beautiful. It's like people would come sit down and, you know, obviously like a pit trade, they talk. And then they had the brand new one. There was only 7 people in the whole building because everything was automated. So nowadays you don't even have to have anyone to do the trading. You just, everything is automated, so you can have access to all the information. With that in mind, let's talk about the risks of investing in emerging markets. Political risk is everywhere, but more so there because, you know, again, it goes back to the culture, the taste of democracy. The democracy is the meaning those countries completely different than other countries. They've been obviously been controlled already, and because of their history, a lot of times they never had gotten that autonomy that they needed, and once they had it, they never had it enough, and then they could not define it. So that's one big problem. The currency risk is very obvious because it is a reflection of the country's strength, and that's becomes a big, and as I mentioned to you, your total return comes from both currency and the return on the markets. Economic risk, they're much more vulnerable than developed countries just because of the stage that they are in. The corporate governance is still in infancy, so although it's growing, but they're trying to, come to the, because of all the international agencies watching them and a lot of funds coming from access to the capital from overseas, so they are watching. But still, it is difficult. The insider trading in some countries is very much acceptable. That's changing, but still, it happens. The lack of liquidity, all it takes is one contagion, one problem, and then all of a sudden, because of so many foreign funds could be there, they can pull the rug out and take the money. Or any type of problem, they do not have, the reserves are not adequate a lot of times. The lack of protection of investors, the government can come and say from tomorrow, and I use this, when Motorola was getting this permit in late 90s, early 2000 in China, or McDonald's, I mean, China just changed the laws and said, oh, you know what? After investing hundreds of millions of dollars and going to the billions, they decided, yeah, we want to change the rules. Operational efficiency also, again, it's more with the technology, but also the risk management side of things as far as operationally goes, it's not as developed as, let's say, Western world. Black markets are very important in two ways. One good way is, sometimes you look at the poverty line and you use the government statistics. So a lot of people they are very much, they're poor, but because it's a cash economy, a lot of things are happening. They do have some money, and a lot of people who died in poverty, they found out there were millions of dollars buried somewhere. On the other hand, because of the black markets, the government doesn't get the revenues, because about, let's say in Vietnam, is about 20% of the economy is in the black market. So that's what it becomes very difficult to monitor the growth of the economy, because a lot of money is done in cash. The last but not least is a lack of capital. Again, depending on the potential of that country, how will the flow of funds will happen. And obviously, like anything else, they need the capital to grow. There are many more, but again, with respect of time, I wanted to just mention briefly. The last but not least, I thought this is very interesting. This is the Tehran Stock Exchange. So talking about developing countries, and this is a frontier country. It has a very small stock market. It's about maybe 365 companies. It's very much, I think it's manipulated by the government, but whatever, it's not very transparent. Let's put it that way. But look what happened. This is a 6-month chart of Iran stock. This is Tehran Stock Exchange. We were at 250,000, and we are closing above 1 million. In 6 months, we have quadrupled. I remember I was like 2 years ago in May, it was at 95,000. Imagine if you put your money in at 95,000 and you sold it at 1 million. That's 10 times your money. The currency has depreciated about 70%. So even at that, it's when you look at this 11 times 0.3, you still would have made good return on your investment. So there are countries like this, but lack of liquidity. This is a good place to talk about currency risk, government risk, political risk, because they can say, well, which is happening now. You cannot, you can sell this, have $1 billion, but you cannot take it out of country. Okay, so these are the things that it's not just about the return on your money, but also the other things that you have to kind of be aware of. I do have, if you're interested, I put this link, which will be part of our PDF. I wrote an article about a few years ago about investing in Central Asia and Middle East. So you might find it interesting, some of the factors that I used, including soccer, how that plays, let's say, in Middle East cultures and investing in those countries. And I also have a YouTube video if you're interested about international investing. I go much more in details, about 90 minutes or 100 minutes. So that's just on the respect of time. I'm going to be a little quicker because I know the time is of essence for you. So every week I like to introduce a strategy of the week. And this week I thought kind of combine one strategy, one indicator. I call this channel. And every week, what I like to do, I want to share something which is simple and accessible. I mean, as you know, I love Finviz. I promote that a lot because it's a free site. It has a lot of valuable information, and we can do just so much with just information we have in Finviz. So what is a channel? Channel basically means when stock has been in a range. It's almost like a rectangle. So this is a pure channel. You have channel up or channel down. So what you do, you just connect the low prices, which is like it almost becomes multiple bottoms, and then you connect the high prices. And what happens, this becomes a range bound that it respects. So when it comes down to this price, let's say at $5, the buyers feel this is a great price. So they get in and they feel that's a fair value. Then it moves around $8. The seller say, wow, this is a great time to sell. And basically we will not accept anything more, or the buyers say that we will not pay anything more than that, and the sellers agree, and then the market goes down again. So this is the channeling, it helps you in two ways. Number one, we mentioned about trading and investing, or like a swing trader or investor. If you're a short-term trader, you might want to use these patterns, knowing that if you're around this area and has respected it, then you know you can buy it around $5, and as it gets close to like $7.50, hey, you can get out of that and make a couple of dollars, or even better, you can play options on it, and you can use confirmation from RSI to stochastics if you wanted to. So basically, this gives you a good income strategy. And the longer the channel, the better it works. But also, if you recall, I mentioned we were talking about this S&P and gold and dollar, but also it shows you there's a lot of energy being coiled. So once it breaks out of either side of it, it really moves. So in this situation, this is the hotel real estate, it's a REIT, and this company basically pays about 19% in dividends. Has been just coiling back and forth, nothing to do with the market. As you can see, okay, it's sold out because of many reasons, obviously with the hotels. But it has been ranging. But look what happened over the three moving averages, which in this case I also put 8-day because I'm working on the short term. So is 8, 20, and 50-day, they converged. And right around here, something was happening. And then 3 days ago, look at the volume, it actually broke out of this range, and it was about 850. And look what happened in 3 days, is up nicely about 30% or so. So this is one way of using, or two ways. Basically, you can either play the range bound and play options on it. You could actually sell, like around this area. Let's say if it's here, you can sell put, for instance, naked put if you wanted to, like at 450 or 5, and say, well, I love to own it at 5 and collect the premium. Or you could actually buy call options on this. And now when you have a breakout, you need a confirmation, which you got, again, you had 2 above. And but also look at the opening the mouth. We call these, we call it papillon, or like a bow tie. When there's a bow tie, when the moving averages converge and then they open up, they are very good indicators for a much bigger move. So all this energy was here. We can do that on a weekly. The longer the range, again, the bigger the move. So the move, also you have to remember, you look at minimum movement is usually when you have channels or rectangles, you look at the difference between the bottom and the top line, the support and resistance. And minimum movement is, if it's upside, is that amount. So what I mean by that, if the top is 8 and the bottom is 5, so you have a $3 of difference. So once we break above 8, it usually moves $3, which is $11. So that's how you can make targets, whether you do options or you just buy the stock. So I thought I'll share that with you. The other thing is I thought I married that with the technical indicator of the week, which is the average directional movement, or ADX. And what ADX does means nothing. It doesn't give you a buy or sell signal. Basically, ADX tells you if there is a trend in whatever investment that you're using. For instance, if it's stocks, if it, let's say, moved up in this situation, let's say the stock that we looked at, if that movement was really meaningful, what that means is this had enough momentum to continue? And is this a real trend? So if ADX is above 20, that means yes. But let's say it just didn't move and it stayed around 15 and 14. That means this movement, usually it will fizzle out. So if you're playing a breakout, then you want to have ADX of bigger, more than 20. If you're playing range bound, let's say that the thing tried to break out, but then it came back in and let's say at 14 or 13, then you know it's going to be that range bound again. There is no real trend. So one of the things you could use, I mean, this is Ambev, it's a Brazilian beverage. It's a company that you could see there is, this is the range again, multiple bottoms. We broke above that, a nice volume. But this line, this black line, is your ADX. As you can see, we are at 27.10. The 27 is above the 20. And because of that, that means this has legs. So the trend has changed. But also, these two, when it's green and blue, they're called DMI. And what they call, when the green is moving up, that means your movement is to the top. So you have a trend. The trend is neutral, doesn't mean anything. But if it's the green moving, that means the movement is to go up. If the red, like here, the red crossed, and this is moving up, when the red is moving up, that means there is a trend, it's going to continue, but it's to the down. I hope it's clear. Now, this ADX is available again in stockcharts.com. You can just do that. It's a good, maybe for 1 or 2 hours over the weekends if you want to try it. That is, then you can use it with the indexes or country ETFs, anything that you like. I'd also, this BTU is a coal company. Had gotten killed. I mean, look where it was, you can understand. But this is something, again, I thought it's interesting. You know, since March, we've been just range bound, going back and forth between $2 and $4. But we're trying to do something with the markets. And the trend is, on the other hand, even though you have this big green, still contained. But look, the ADX is at 10. So that means this movement, we are not sure if it has legs. Till this goes to 20, you know, this probably just a range bound. Just, it'll be interesting to test it out next week. Just food for thought. I hope that was helpful. Now, this is Finviz. I thought I'd put it in the slides rather than just go live, because I think, I'm hoping you would review the slides or the video in the future, because this is the beauty of, again, the Finviz. When you open, this is the home page. You go in there, it gives you all the indexes, what was the best movement. This part, right under tickers, this is where is like these are old classic technical analysis. So we have classic and then we have modern, which is mostly indicators. The classic goes back 100 years. There was a dot theory, and then if you ever want to read a really good book, which is almost like War and Peace, is Edwards and McGee, which is the first real technical analysis book in 1948. They do look at all the classic patterns in you know, from triangle ascending, and you can do head and shoulder, double top, double bottom, triple top, triple bottom, and all that. But so this is where you can find, you can just press on the channel and it gives you all the stocks. I usually like to have more volume, so you can just use the high volume if you want it to make sure it has validity, and you want to make sure if there's a breakout, it's out of the, the high volume breakout. Okay, so this is how you can find it. We almost we're almost out of time. So I just thought upcoming events for the next week. Just watch for it. It's like Wednesday at 11. Just watch for Fed Chair Powell's announcement. See what they're gonna do. Or do they think that things are getting normalized, or maybe they're gonna taper off, or if it's what are they gonna do with the interest rates? Because the one thing that Fed doesn't want, and that's for the reason I showed you the 10-year note yield. That was a huge move. I mean, they want to keep the interest rates low. So are they going to interfere, or going to say, well, we are not going to interfere and let the market decide, and maybe market will push the bond yields lower. So we'll see. But that's what I think is important. But also I thought for the month of June, which is important to end up this month, there's two factors you have to think about. Now we are out of really the earnings are kind of out of way. With July, it's going to be we're going to start the new earnings season starting. But first of all, there's schools are closed, which they were never really open for the last 3 months. I know my children, they had their finals and they returned their books. But I don't know how much summer activity will be. So that usually if you have the summer doldrum, people travel. I don't know how much traveling will be this time. But there is something important which is happening at the end of the quarter, window dressing. With the volatile quarter that we had. Now, what happens is a lot of fund managers who missed the boat, maybe they had some big winners they didn't buy. What they try to do is they look for good quality the big winners, and they wait till, let's say, June 28, 29, like till the almost last 2 days of the month or last week. They gradually accumulate some of the companies to show to their shareholders that, listen, oh, we owned Amazon all this time, or Facebook, and whatever the company. So they look for those winners. So that's one. The other thing I want to keep in mind, all the exchange traded funds, they do have something called the 90-day rebalancing. So what happens, a lot of, if you're not familiar, they look at beta ETFs, and basically beta ETFs look for performance. So what they do, they get rid of every 90 days, they get rid of their losers and they buy the winners. So because of that, then you will have some shuffling, some of these companies. And that's what I mentioned. June will be a good month to look for some strong companies with the good balance sheet, but also good growth and, again, solid fundamentals to look at. And then you can use your technical indicators. All right, the last slide I have for you is some of you, focus on investing just in stocks. Some of you, I know you have done futures, Forex. I really enjoy options because it gives me a lot of mathematical tools, and also doesn't limit me for the movement of the markets. I can still make money even if I'm wrong. If you're have no experience, but let's say you're interested and you call your broker and you want to open an account, usually there are 4 levels. And I encourage you to tell them, well, you have a lot of experience. I mean, they don't really check on anything because they allow you 4 different ones. This is the first level everybody gets. And usually it's available when you have IRAs. If you have no experience, so that's called covered call and cash secured puts, or married puts you call. And that's the first option. And it makes sure that you have the stock holding before you can do anything with their options. Level 2 is the most popular. A lot of people have it because now they can buy call options, they can buy put options. So basically it's about longing positions, and it allows you to buy. Basically you cannot sell, you just buy. And in IRAs you can do this. but it stops right there. If you're more experienced, then that's where you get to level 3 and you can do spreads. What that means is combining buying and selling the options at the same time to take advantage of having limited risk, but also maybe receiving premium on the strategies. And there's like many strategies, and this is a great place to be, actually. If you want to, that level 3 will be what I aim at. If you're really speculative and you really like risks, then you have naked calls and puts, which allows you, without holding the stock, no background, you're really completely on the margin, and that's level 4. And want to make sure you've had a lot of experience, you have the capital to make sure your risk is covered. So I just thought this question had come up last week, so I thought I'd just share that with you and make sure that you understand the levels. Anyway, it's about 3:37. My apologies that we've run over a few more minutes, but I really appreciate you being with me on your Saturday and taking your time from your wonderful weekend. And thank you for our guests from overseas and back east and Midwest, and we got Nevada and California. So with that in mind, Sean, if there's any questions or anything I can answer, I'll be happy to take the questions.
Sure, I'm going to unmute everyone.
Please.
I think now the system changed. I have to ask to unmute everyone because most people unmuted themselves. So if you have questions, you can just unmute yourself and
let me see if there's any chats.
I mean, I have a question.
Oh, please, Jacqueline. Yes.
On the ADX.
Yes.
Does the red line have to cross the green line for it to be a signal, or vice versa? Do you need the crossing, or?
Good question. So again, with ADX is standalone, so it just gives a direction. So basically, what you want, if the ADX is crosses the 20, and then, like you said, if the red is crossing green and the slope is upward, then that means because red is the sell signal and now ADX is over 20, then the momentum and the trend will be negative. If the green is taking over and cross the red, and usually it does cross the ADX line, then that means the buying trend is strong and it will continue. So yes, so that's usually you want to basically the colors be above each other. So if the green is above red, that means, and the ADX is over 20, then there's that buying power or momentum. Yes, good question. Thank you.
Hey, Ramin.
Yes, Henry.
So you talked about the markets kind of being in euphoria right now. And I know that you mentioned several times before in previous meetings that a lot of this trading is retail, mostly retail trading. You talked a little bit about the fund managers, what you think they're going to do in June, but in general, do you think there's still a lot of money on sidelines that's institutional money that we can anticipate being done with the market, or yeah?
No, I understand. Yeah, very good question. Yes, there is actually, there's a lot of suspicion of this movement. There's a lot of, I know fund managers that they are not convinced, but it doesn't really matter if they're convinced or not. Sometimes you just give up and just, when all the lines are broken, when the resistance and the buyers are in there, you just throw your arms and, but that makes the markets vulnerable. So what I've been trying to do, again, I'm approaching this more of a trader, and it's been really good from that point of view. And again, it's not every day I just put my bias aside. I just want to be aware that the risks they are still there. This is not an organic growth. So, but you're absolutely right. There are still money. I still believe there's a lot of retailers who are investing because they have the time. And what will happen if the economy opens up and these people go back to work, then that might affect it. I mean, we'll see what happens in July. Now, with again, unemployment money running out, I think it's going to go end of July. With the stimulus package, if the economy started moving, the Senate has already come and said that, they're not sure, they approved that 1 trillion, but are they going to do another one? Or that puts it really question mark. So in reality, it's the fuel has come, in my opinion, more from retailer than the institutional. And but the reason I mentioned about the ETFs have no choice, because ETFs, when they do rebalancing, they just do it. They do decide whether the same, because that's their investment policy. If it's especially with the beta, fund managers by law, if they have to invest 90% all the time, now that's what goes back to the thing I mentioned. You want to be in a good quality companies. Granted, like we talked about airlines and leisure, and I'm looking at like Wynn and MGM. I mean, they have moved very, very nicely. So basically, what is the future for them? But there's some companies that, and that's why I think it's important to look at their bond rating. But some company has no business, they have lots of debt, and they've been moving much faster than some other companies. So that's why I would say just be cautious, just be ready. But you're right, there is still, especially from institutional, there's still more money on the side which can fuel. And remember, there's a lot of algos, the computer programs, that they constantly are evaluating the situation. And they're the ones, once again, these targets are broken, they will actually put the money in or take it out. So this week I think, is a crucial week again. We have gotten out of the range, but let's see if we have a follow-up. On the other hand, some people, maybe they were new to the business, is investing, and they already made 20, 30%. They're so happy. They made it for the next year. So they might want to just lighten up and say, well, it's nice to go for Boeing, go from, let's say, 100 to 180. Hey, you can't beat that. Let's get out of this. So, but other than that, yeah. So these are interesting times. Fundamentally, don't make sense, but it's not for us to make that judgment. We just go with the price. So, but that's a good question, Andrew. Hopefully next week we'll have a little better answer to see what happens.
Thanks.
You're welcome.
Hi, Rami. This is Siamak.
Hi, Siamak. Yes.
I had a question. Maybe you can elaborate a little bit more about the unemployment number. So the way I took it is, because of the PPP program, there was a lot of push to spend the money and rehire, actually, a lot of your employees, if you want to take advantage of forbearance,
yes,
forgiveness. So are you kind of stating that maybe the Fed missed that portion, or there's something wrong in their prediction and it's misaligned, or what are you, I guess, can you just elaborate on that?
Absolutely. So the question is, so in April, so basically that, first of all, the labor business, the Labor Bureau of Statistics, when they came, they actually have accepted that they made a mistake. So basically, if you're looking at the 13.304, it's actually 16.4. So they already said it is not really accurate reflection. So the question is how they did it. So in April, when they were, basically, like they actually called, they do this polling, and they called, let's say they called me and said, oh, do you have a job? And I say, no, because I didn't know, I got furlough. And then I go on unemployment. And then my employer gets that let's say the PPP or the other fundings, and then they say, oh, we have to use that money on a payroll. They call me back and they say, well, you know what, you are back on the payroll. And now next month when they call me, I say, oh, I am on the payroll. So the adjustment, they did the adjustment for the month of April, but it was only like 1% or so. So it wasn't a big difference. But that's the clarity is not there. So I think this month it might be a little better understanding, but you're absolutely right. Because of that money, 75% has to be spent on the payroll. They had to call their employees. Now, if they didn't show up, then they have to hire, because otherwise they have to, they only got 8 weeks. So that's why I don't put, it's interesting because everybody's scratching their head. I've never seen this. I mean, it's supposed to be from the worst month from the employment point of view, we went to the best month. And how could all economists miss? I think it's the way the system worked. So I'm hoping that there are more people coming back. Obviously, it doesn't. The earning part was dropped a little bit. So basically, again, we're looking at the things might be even better now because it's from May 13 to June 13. On the other hand, again, some people, some employers I've talked to, they said they might not even hire those people because, as I said, they've decided just keep the unemployment and they didn't want to come back. And they want to, some of these businesses, they just want to be lean and there could be some adjustments. So it is head scratching, CMH. I don't know what is, because I was listening to Mohammed Elarian, from Allianz and old PIMCO guy. He can. I mean, nobody can understand. It's amazing. All I know is the markets. That's what they did, and that's what I wanna look at the price and see how the markets are reacting. But on the other hand, just a food for thought for all of you is we are very emotional, and that's what I mentioned about why I think there's a lot of retail investors in the business right now. Trading is, as I had mentioned before, Charles Schwab, TD Ameritrade, E-Trade. It's been the record time for opening new accounts. Again, everybody has time. They have the internet. There's no work to go through. So basically at home, what happens is every time from Gilead to Moderna, the Navarax, and every time there was like a phase 1 something, there was huge reaction. And usually institutions are not the ones who overreact to these news. That's just my opinion. You could see that, and then everything fizzles out. So that's my conviction that this is not the majority of either there's a lot of algos and day trading going on, or it's a lot of retail investors. So, but again, who am I? I'm just gonna basically take advantage of time. All I want all of you be ready is it's good time to invest from the both sides. I mean, be ready to, when things drop, they drop very fast. So just be prepared for that and own some really good quality companies and just stick with them. So that's all I can say. Is that a little more? Again, I wish I could have a better answer for the analysis of the employment, because as I said, everybody, even you read Barron's and you listen to Bloomberg, and they still cannot understand how did this happen. So.
Thank you. I guess we'll just have to wait till the next reading to see if
exactly. I think, yeah. But there's a lot of, again, one thing I would say though, this is like, if you look at the U6 employment numbers, which it includes the discouraged people who are looking for a job or part-timers who cannot find a full-time job. I mean, the numbers are staggering. So even self-employed 1099 people who don't, so they don't include that, but it's always been a problem. So anyway, yeah, we'll just have to wait. So, but right now we just look at the markets and stocks basically, or whatever, and take it from there. All right. Any other questions? Let me see.
So Ramin, I have a question.
Sean.
Yeah.
Yes.
So Because a lot of the indicators showing it's actually overbought condition. You also explained that in the market review. Let's say when the market goes down, how do we detect whether it's just a correction or it's possibly the second leg? Is there a way we can, from either price behavior or volume behavior or other behavior to tell that?
Very good question. So what happens, there is, and I meant to talk about this in the past, but just put it organized. You need confirmations, and I'm not talking just from the technical and not even the sentiment. You want to make sure, let's say, if the stocks are going down, what happens, the risk on investments. Now, what that means is I look at, for instance, I look at the VIX volatility, and I look at the bonds, I look at Japanese yen, then I look at like the transportation and to see that is that going down? Is Russell 2000 going down or NASDAQ? So basically I need these confirmations to see if this is real leg. So there have been times that, let's say, bond market goes up and stock markets go up. Or there are times that the gold goes up and stock market go up. But the thing is, and the Japanese yen go up. So I have to know, is there any contradictions? On the other hand, you can see there are times that stock market goes down, everything else is going down. Then if that's the case, the pressure is so much that it is going to continue if there's a big time. So, but I do look at the risk on and risk off. Those are my big indicators. On the other hand, from the technical indicators, now what you do, basically you want confirmation. I don't want to give so many, but let's say you look at the support zones, you look at the moving averages, because usually your first support, but also you look at stochastics and like RSI, right? So, and then MACD is more of a lagging. MACD does, because it's a moving average conversion divergence. So I don't put a lot of value as a leading indicator, but believe it or not, stochastics and then RSI, being the oscillators, there are momentum readers, they kind of lead the market. So if they give you the confirmations, number one, that you go from the embedded, which is above 80, and then you cross that 80 and you keep going down, that's one breakdown. So if it continues, that tells you heads up. Then the other thing is, again, you look at the moving averages and basically you look at the support and resistance. If you keep breaking, one of the things I would say, and I would do it in the future, and hopefully I will talk to everyone individually. I'm glad you mentioned that. It's about the option analysis of the market makers. They put what they feel what's going to happen to the market for the next week. They priced it in. And every time we go above that continuously, then there's something is happening. There's like this, and we have to get back to normalcy. So I will teach you on how to read the options expected movement. And that also gives you the confirmation. So the last thing I would say, just look at internals. There's the advanced decline line. You look at the put-call ratio. You look at the trend. So all of these, they tell you the ticks. You want to see if these have legs, or this is just, as I mentioned before, because like let's say NASDAQ has, if the Apple and Microsoft, everything is going down, but 80% of other stocks are going up. Is this a true indication of this is really a breakdown, or is it just a rotation? So one last thing I would say is you also look at your defensive sectors. So if it's like utilities are leading and your big industrial or economic sensitive are really going down, that also another confirmation that this has legs. Basically, the markets are becoming defensive and they see something. So we'll see. But the main thing would be that bond market. I would watch the yield. And it should be interesting to see what happens on Wednesday, what to talk. And the last thing I would say again about this is the LQD. That also is a good ETF, leading indicator to see what they're doing and if they're really breaking down. Because the bond market, credit is what leads the stock market, not the other way. So it's a long answer for your question, but maybe we should do one class just on that. That would be a good one. And with that, Sean, I mean, as long as everyone is here, I like to, because we are moving to more of a subscription-oriented as far as webinars, I would like to hear your opinion in regards to, would you like that? So I was thinking that the market analysis that we do, maybe it takes 15 to 20 minutes. I thought maybe I can, every weekend, I can record that, because it's not really, it could be interactive, but I can record it and just have it separately, and that would be available to public if anyone wants. And I just focus on more of a strategies and education and some of, as far as technical tools that I use for option trading, some of the strategies, and focus on that, and we could have a longer Q&A. Or we just leave it the way everything is now, basically do combination of everything and just available for you on no public access. So I'm open for any suggestions, or you can just email me or text me with your ideas. I would very much appreciate it. So just a food for thought. Okay. Yeah.
Okay, wonderful. Well, if there's no more questions, today we'll finish at 4 o'clock, and the recording will be uploaded along with the slides, and wish everyone have a very nice week. Enjoy your trading.
Thank you so much. Thank you, everyone. Have a wonderful.
Thank you, Rami.
Yes, sir.
Thank you.
Thank you.
Thank you, Uncle.
Thank you. Bye-bye now. Bye.
Bye.
Bye.